We just got a manufacturing read that was the lowest level in years. The 10-year yield is now at 2.10. Are the chances of recession this year really zero?
They're low if you look just at the economy. And I think Kevin Hassett is correct in saying if you just assess the economy, what has changed, Sarah, are two things. One, the risk of a policy mistake has gone up. What happened on trade last week was different in two ways. One is the escalation of tension with China is now targeting specific firms. That is quite a different. And two is the threatened tariffs on Mexico means even if you make a deal with the U.S., you could still have issues. So the risk of a policy mistake on trade has gone up. And the other one, you know it well, is the self-fulfilling concerns in markets because of where the pain trade is. And the more disrupted the fixed income market, the more the risk to the economy. So I still think the baseline is low recession, but the risk of a policy mistake and a market accidents have gone up.
What about if those tariffs on Mexican imports that totaled, I think, more than $350 billion last year go from 5% to 25%? What kind of economic damage are we looking at?
So a lot of damage to Mexico, and the market is sensing that. But for the U.S., some damage, but the bigger issue is what happens in negotiations. You know, the rest of the world thought that they understood the new game plan for negotiations with the U.S., which is forget about this voluntary process of solving issues, forget about going to the WTO. You've got to make concessions to the U.S. What the threat against Mexico says to them is even if you make concessions to the U.S., you may still have problems. So expect China and later Europe to become much more hawkish in their negotiations with the U.S. And you're seeing that already over the weekend.
Mohamed, this morning, the yield on the 10-year bond hit 2.07%. What is that saying to you?
So saying a few things. I think first, the markets are worried about growth prospects because of what happened last week, are more worried. Secondly, the pain trade, the technicals are such that they accentuate the move. It's been a massive two-day move, David. And third is don't underestimate the fact that the vol index on the bond market, the move, has spiked a lot more than the equity index.
Mohamed?
Yes.
Hey, Mohamed, sorry to cut you off. I just want to show viewers what we're looking at here, which is a live picture in London where the president is at Westminster Abbey. He's laying a wreath at the grave of the unknown warrior. Let's just listen in for a moment.
And let us pray for the peace for which they strove. O God, who would explode both heaven and earth in a single peace, let the design of thy great love lighten upon the waste of our wrath.
You were in the midst of discussing the implications of a yield below 2.1%, at least as of this morning on the 10-year, when we interrupted you. Feel free to continue.
Yeah, David, I think what you should look at is not just that the yield is below 2%, is that the vol index on the bond market has spiked a lot more than the equity market. And that's simply telling you that the vol market sees a lot more unusual uncertainty or radical uncertainty ahead for the economy than what stocks are pricing in right now.
Radical uncertainty means what, in your opinion?
I think it means an economic outlook that is more vulnerable. I think it means market technicals that are more fragile, and it involves a higher risk of a spillback from disrupted markets to the economy. It's a different outlook than it was last week, and let's see whether we can get back to where we were before.
What about, I mean, we talk a lot about the direct impact of the tariffs, right? Who pays, the importers, which economies get hurt, the exporters. What about the indirect impacts? How do you think about the spillover effect to CapEx decisions at company levels, the uncertainty in terms of planning, the price of crude oil? I mean, there's so many sort of ramifications that go just beyond the direct trade impact.
There absolutely are, Sarah. That's why containing the issue was so important. The minute you no longer contain it, you get this radical uncertainty. And what does that do? You postpone decisions. If you're a company, you postpone decisions. And if you're a consumer, and that's happening in China much more than the US, you postpone your own consumption decisions. So demand comes down, and that then feeds back to the supply side. That is the risk of this uncertainty.
Yeah, this morning we had Ed Breen join us, Mohamed, the executive chairman of Dow DuPont, saying since December, in China specifically, they've seen a significant decline in consumer demand for big ticket items. Does something like that concern you? Does that spread? Does that have an effect on the European economy, where a lot of the automobiles perhaps that the Chinese would be buying are manufactured?
So we certainly should worry a lot more about China, because you get three natural inclinations coming in that actually hurt the economy. One is the consumer is typically risk averse. So what do? They step back. And that is a problem not just for China, but for the rest of the world, particularly Europe. Two is that the government goes back to old tools that are less effective in promoting growth, but are more problematic for the transition. And three is that China itself becomes more hawkish vis-a-vis the rest of the world. So I think you worry about China a lot more in this outlook than you've done before. And if you're dependent on Chinese markets, like Germany is, for example, that's an issue for you.
So if you add it all up, Mohamed, have you adjusted your forecast for what the Fed is going to do this year? What's your prediction? The market says 50 basis point cut. That's half a percentage point.
And it's really tough for the Fed, because based just on the economy, you can't justify a 50 basis point cut. But remember, the markets have gotten conditioned to be able to force the Fed to do something. So if the Fed doesn't validate Sarah at the 50 basis points, we risk the market perceiving a policy mistake. Not an actual policy mistake, but the market's perceiving a policy mistake. And what does that do? It disrupts market functioning, it tightens financial liquidity, and then it contaminates the economy. So the Fed is in a really tough place, not of its own creation for the Powell Fed, but of the creation of the previous Fed that gave the market everything the market wanted. And now the markets want more.